Good day and welcome to Stanbic IBTC Holdings PLC full year 2020 financial result presentation. Please note that this session is being recorded. There will be a presentation by senior management of Stanbic IBTC Holdings led by Dr. Demola Sogunle. At the end of the presentation, there will be opportunity for participants to ask questions. If you wish to ask questions, please click on the raise hand button, or you can drop your question in the conversation chat room. Again, if you wish to ask question, please click on the raise your hand button, or you can drop your question in the chat room. My name is Idris Toriola. I'm Head Investor Relations, Stanbic IBTC. I'll now hand over to Dr. Demola Sogunle for the presentation. Thank you.
Yes, thank you, Idris. Distinguished ladies and gentlemen, good day once again to all of you. You are all welcome to Stanbic IBTC Holdings PLC full year financial results presentation. Earlier today, already sent the presentation deck, which contains basically 7 slides. What I will do is to take us through very quickly the background and the operating environment. And as I'm talking to you, I'm on slide 4, where we want to state once again our mission as an organization. And the reason we exist is that we are committed to solutions that drive your progress. And our vision, what we aspire to be. We aspire to be the leading end-to-end financial solutions provider in Nigeria through innovative and customer-focused people. And in terms of trying to deliver on our purpose, we've got 3 strategic priorities. First one is transform client experience. The second one is execute with excellence. And the third one is drive sustainable growth and value. Say that production 10 million barrels per day by the members of reduced Nigeria's oil production numbers, averaging 1.5 million barrels per day compared to 1.78 million barrels per day. Meanwhile, oil prices, remain very volatile most of the year. The country's external reserves were on the downward trajectory in 2020, closing the year at about $35.3 billion. Excessive market liquidity with very few investment outlets ensure that yields across the curve declined in 2020. We got to the point in the course of the year where even yields on treasury bills and OMO instruments went below 1% per annum. Headline inflation was on the upward trajectory in the course of the year, averaging about 13.21% compared to 11.39% in 2019. We all remember that we started the year with headline inflation of about let's say 12. By December last year, headline inflation crossed 15% mark. The exchange rate also witnessed some major pressure, depreciating at the various markets as liquidity across FX segments declined significantly during the year. You remember that let's say in the first 6 to 7 months of the year, the FX market was more or less shut down. Then the CBN maintained, if you look at what CBN did, the CBN maintained some sort of balanced approach in monetary policy management, by on one hand, easing through its loan to deposit ratio policy, as well as reduced issuances of OMO instruments, while on the other hand, tightening through the massive cash preserving methods. It's good very quickly to give us an update on COVID-19, from the domestic point of view. And in Nigeria, we saw, the positive cases, trending towards 160,000 people. We saw fatality rate about 1%, recovery, around 90-something%. As we speak now, earlier this month, vaccination had started, and some of our staff members have actually got their own vaccination. However, it's important to let us look at what we did, in terms of response measures that we took to ensure business continuity. We had to deal with our people and systems. We got to the point where about 40% of our workforce were working remotely. We also had to deal with customers, in terms of communication and making sure that we share so many things with them so that they can remain safe. We also did a lot in terms of liquidity and capital, just to make sure that, we've planned different scenarios to ensure that, look, we are a sustainable business. Then when it comes to, our client focus on the back of COVID-19, we did loan restructuring, we did, trade tenor extension, we did fee waivers for customers. You will see all this, when you go through slides 8 and 9. When it comes to the intervention facilities, I mean, we had to grant, dispensation in line with, the pronouncement from Central Bank. We reduced the interest rate applicable on all those intervention facilities by about 400 basis points. And we also made, serious donations, so as to be able to help impacted people. And we went into serious partnerships, with, like-minded entities. At this point in time, I would like to hand over to Kunle Adedeji, our CFO, to take us through the financial review.
Thank you, Demola, and good day to all of you for joining us on the call. Slide 11 to 13 highlight the key performance indicators for the year. The group ended the year with a resilient financial outcome enabled by our diversified business model. So if you look at slide 11, you will notice that our gross earnings remain stable, though with a marginal growth of 0.3, and this was largely supported by growth in non-interest revenue. This is despite the slowdown in business activities and the regulatory-induced decline in margins and fees, which we felt seriously in the PPB business segment. Earnings per share improved by 5%, following the same trend with profit after tax. Profit after tax went up 11%. The outcome resulted from about 7% growth in total income and well-managed costs, despite the impact of strong provision levels. Return on equity contracted a bit due to enlarged equity base. Significant improvement was recorded in cost-to-income ratio. We had excellent outcome on both income generation and cost optimization. We reported credit loss ratio of 1.6%. Though this 1.6% is still well below our guidance for the year, but what came higher than 2019. The increase in CLR is due to accelerated provisioning on 2 delinquent assets rather than a general portfolio deterioration. I would like to note that even on non-impaired loans, we stress our forward-looking indicators in recognition of deterioration in macroeconomic conditions. On slide 2, you will notice that our total assets increased significantly on the back of increased funding from banking and custody clients, and this enabled us to grow risk asset and financial investment. This growth in total asset weigh in on return on assets, despite the 11% growth in profit. Net customer loans and advances grew by 17%. This resulted from the new drive to grow quality loans to support our clients, and also to douse the impact of reduced yield on government securities. The risk asset growth was supported by a solid capital base as well. Year on year, we had a marginal pickup in NPL ratio from 3.9% to 4%, largely on account of adverse grading of 2 clients. One in construction and real estate sector, and the other in the downstream oil and gas subsector. But just to note that we maintain 100% provision coverage on these 2 assets in line with our prudent process. The classification was moderated by growth in loan book as well as write-offs in PBB space. Customer deposits growth supported liquidity during the period. But if you look at the details as we go ahead, the growth came mainly from low-cost deposit category, and this moderated our cost of funds. The proportion of current and savings account also improved to 83% from 71% last year. So now I'll move on to slide 13, where we have the earnings waterfall. The earnings waterfall show the contraction in both interest income and interest expense, with more absolute impact on interest income, thereby contracting margins. The positive impact of the growth in non-interest revenue was more than enough to cover the decrease in interest income, thereby resulting in a 7% growth in total income for the year. Just to note, our non-interest revenue was about 125 billion. It was more than enough to cover our total cost of 95 billion for the period, thereby improving our burden ratio. On slide 14, we have analysis of our net interest income, which came down 5% year on year. Strong loans and financial investment growth were offset by steep margin decline as a sort of the low interest rate environment. And it was also heightened by the opportunity cost on increased excess cash reserve balances. So we had a depressed asset yield despite the growth in loans and financial investment, but interest expense declined by 20%, and that helped to improve the NII a bit. On slide 15, we have highlights of our non-interest revenue. If you look at the line, non-interest revenue improved by 15%, but largely supported by trading revenue. On the gross fees and commission line, we had a 1% marginal increase. During the year, there were pressure on some fee lines for the banking subsidiary especially, but the impact was moderated by growth in fees on asset under management from the West space. Fees on electronic banking transaction declined by 21%, despite the growth in volume and value of transaction. And this is due to regulatory directive on tariffs. Custody fees declined by 34% on the back of 30% drop in asset under custody. So if you look at trade, you look at transaction-driven fees, they all reduce on the back of downward reduction in business and consumer activities. And the pandemic also contributed, especially in Q2 and Q3. But the outcome on fees on asset management was quite encouraging, 11% growth. That's about almost 5 billion increase. And this is on back of 20% growth in AUM, which went up to 4.63 trillion. Trading revenue contributed significantly. This was supported by gains recognized on long position in securities ahead of the decline in rates, some appreciable income from OTC futures, as well as income on derivatives. I move on to slide 16. Net credit impairment was a charge of almost 10 billion. Last year was 1.6, but gross loans went up by 18%. So this resulted in credit loss ratio of 1.6. Last year was 0.2. In PBB segment, impairment charges increased due to improved coverage on existing impaired loans and application of stress forward-looking indicators for expected credit loss calculation on non-impaired loans. On the other hand, CIB recorded increased net provision of about 7 billion compared to a write-back of $500 million last year. So the two names that I mentioned earlier, one is in the construction and real estate sector. It contributed about 5 billion. The other one is in the oil and gas subsector. That contributed about 3 billion increased provision. Just to know that we continue to focus on recovery, and as shown on the slide, we recorded recoveries of 4.6 billion. Last year was 3.2. On slide 17, operating expenses were largely contained during the year. So if you look at staff cost, 4% increase. Normally we do inflation index adjustment every year. Operating expenses on the other hand came down 2%. Apart from benefit or gains from new ways of working, which reduce training, travel, entertainment, and related expenses, some of the energy initiative that conservation initiative that we put in place also contributed. We continue to focus on cost efficiency so that we can further improve gains from that area. On slide 18, you will see the composition of our total assets. I think the only thing I want to highlight here is the increase in proportion of financial investment. It went up from 8 to 25%, and this is due to special bills of about 507 billion with a yield of 0.5% that we received from CBN, and this is in replacement of part of our SSCR assets. The ROA, return on asset, came down 3.8. This is due to significant asset growth despite the 11% growth in profit. On slide 19, we have the trend of our loans and advances. You see the breakdown by currency. You also see product contribution. So we partner with our customers in their growth aspiration, with the bulk of the growth on the loans coming from the term loan category, which gives some comfort around future earnings. On slide 20, we have sectoral distribution of loans and advances. We continue to look for opportunities in sector with potential for growth, and also we look at resilient sectors. So largely the sectoral allocation remains stable year on year, but with increased exposure to an important client in the financial intermediaries and insurance sector, which improve allocation to that sector from 1% to 5%. You also noticed that there were some repayments in the upstream oil and gas subsector. That also reduced a bit. On slide 21, our non-performing loan stock, 21.6 billion last year. It increased by about 5 billion. As discussed earlier, or as explained earlier, the classification of two names in CIB largely accounted for the increase. I mean, from a prudent point of view, we increased the coverage to 100%. So if you look at CIB NPL ratio, as a result of that, it increased from 0.8% to 3.5%. But NPL ratio for PBB declined from 9.5% to 4.95%, largely due to both loan growth and some write-off that we did on fully provisioned loans. On slide 22, we have breakdown of our loans into the three stages and the related coverage ratio. Each sector had more than 70% coverage, and for stage 3, we have about 83%. On slide 23, trend of our customer deposit is presented here. Bulk of the growth is coming from transactional low-cost balances. Current accounts, 15% growth, savings, 72% growth. I'll move on to slide 24, where you see that our capital adequacy ratio continued to be higher than the regulatory requirement of 10%, about 25%. But return on equity remain well above our benchmark, though lower than last year, and that's because of the strong growth in equity. In summary, with the resilient set of results for the year, the board is recommending a full year dividend of 4 naira per share to shareholders for approval. So this translates to a payout ratio of about 53%. Last year was 42%. In addition, a 1 for 6 bonus issue to recognize the loyalty and the resilience of our shareholders is also been recommended. I will now move on to the business segment, starting with CIB. Slide 26 to 28 captures the highlight of performance of the CIB business, corporate and investment banking. So for that segment, the CIB business too resilient in the face of the challenging and complex economic and regulatory environment. The business remains steadfast in client engagement, providing clients with quality experience and solution. And in fact, we had more connections, even with this new way of working with our client. And that's resulted in remarkable financial performance in 2020. So if you look at total income for CIB, 29% increase, profit after tax, 37% growth, largely contributed by increased trading income and also net interest income. Trading revenue in particular was quite significant, and as I explained earlier, we announced some opportunity from yield movement. Our leading investment banking business successfully advised our clients on a number of transactions. The stockbroking business is also in that segment. It remains Nigeria's largest stockbroking firm. So if you look at loans for CIB, 15.8% growth, deposit 48%. NPL ratio, I've explained that earlier, that the reason why the NPL ratio went up. So going to 2021, in this current year, what we've been focusing on is growing the client franchise, renewed focus on trade transaction, and improving margins as transaction volume grows. For the next business segments, PBB, if you concentrate on slide 30 to 34, that captures the highlight of performance of PBB. Total income for PBB came down 26% and recorded a loss of 9.6 billion. So this business segment was really impacted by regulatory induced fee cuts. We had a reduction in tariffs from the regulator, despite the increase in volume and value of transactions. The effect of the pandemic also affected the business activities, but notwithstanding, we continue to provide cost-effective services to our clients, and we also improve our digital capabilities during the year. So if you look at our digital transaction volumes, it went up 18% year on year. We also launched the new improved Stanbic IBTC mobile banking app, and we re-engineer and improve our at least electronic wallet. Customer loans was up 21%. Deposit also the same level, 21% growth. So for PBB, we recognize that we have more headroom for growth in PBB business, and we continue to deploy resources into that segment. In the medium term, we believe it should be sustainable. So for this segment, we plan to grow scales in market, improve transactional velocity, and also focus on digitization. For the wealth business segment, slide 36 to 38 captures their performance. AUM up 20%. They've been doing double-digit growth in AUM for some time now. So profit after tax of 25 billion. Cost to income ratio also improved. Return on equity 33.4. So during the period, the wealth business also adjusted its client engagement strategy in response to the challenges posed by the pandemic, and implemented several digital initiatives to enhance customer experience. Within the pension industry, for the pension asset, this relates to the pension asset management subsidiary. So the regulator launched the much-awaited transfer window. We successfully deployed the requested technology and commenced the transfer of prospects from other PFAs. Our game and our plan is that we should be a net gainer at the end of each quarterly clearing session. Finally, we had approval of the regulator to commence manufacturing of life insurance products. So our life insurance subsidiary, we got the approval towards the end of the year, and started operation from January this year. So this will complement the suite of products and services that we provide to our clients. So wealth priority for 2021, they've been focusing on increasing the level of digitization and also overall customer experience improvement. At this point, I'd like to hand over the presentation back to Demola to provide broad guidance for the year.
Yes, thank you very much, Kunle. Distinguished ladies and gentlemen, if you turn with me to slide 39, you will see and slide 40, you will see the highlight of the achievements that we were able to record on the back of the market guidance that we provided. For all of them, we were able to meet those benchmarks, except for return on equity, which came down slightly because of the increase that we've recorded in our capital. Now, in terms of going forward, for 2021, when it comes to AUM growth, we are predicting, or we are guiding towards between 10 to 15%. For return on equity, we are looking at 20 to 25%. Cost to income ratio, we believe we should be able to stay below 55%. Net interest margin, as defined as net interest income as a percentage of total assets, we believe we should be able to stay between 3 to 4%. Cost of risk, we will keep that below 3%. Casa ratio, we believe we should be able to end the year 2021 above 75%. NPL ratio, we will keep that below 5%. Deposit growth, we are aiming for something close to 15 to 20%. And for gross loan growth, we are also guiding towards 20 to 25%. Ladies and gentlemen, I've got my other colleagues on the call who are willing and ready, to take questions. The first one, I've got Wole Adeniyi, the Chief Executive of Stanbic IBTC Bank. I've got Eric Fajemisi, who is the Executive Director for our CIB business. I've got Remy Osuagu, who is the Executive Director in charge of our PBB business. I've got Olumide Oyeton, who oversees the whole of our wealth business. I've got Bumi Dayo Olagunju, Executive Director in charge of operations. And last but not the least, Kola Lawal, our Chief Risk Officer. So at this point in time, ladies and gentlemen, we are willing and ready to take your questions. Thank you.
Thank you very much, Doc. Thank you very much, all. If you wish to ask a question, please, you can indicate by using the raise your hand button or drop your question in the chat room. So, Ronald Gaidia, you can unmute your mic and go ahead with your question, please.
Thanks, Idris. Thank you, Doctor and Kunle, for the presentation and taking the time. 4 questions. Firstly, if you could just talk about your asset management business, what's the experience been so far after the introduction of passporting? Have you seen any significant churn rate on your within your portfolio? Second question is on your trading income. Could you give us some expectations for what you expect on that line item for 2021? Third question is on the on your targets. When I look at your guidance for this year, I see the deposit growth guidance is pretty robust. I was just wondering how feasible that is, given that the sector and Stanbic's deposit growth last year was quite substantial, and I would expect some of that would reverse as depositors find alternative asset classes. And my final question is on your restructured loans. Could you maybe just give us how much provisions you've made on that portfolio, and just give us some guidance in terms of what kind of default rate you expect from that portfolio going forward? Thank you.
Yes, thank you very much, Ronak. 4 questions, as usual. We will take them, somehow in a reverse order. So, Kola Lawal will handle the one that has to do with restructured loan portfolio and the default rate. Kola, you have the floor.
Thanks, Doc. So, in terms of the provisions that we have there, I think the first point to make is that most of those loans are still sitting in stage 1, and we simply took a prudent view through grant extensions, mainly between 0 to 6 months. Most of the extensions on those facilities that you see as restructured. Secondly, in terms of default rate, I guess given that most of them are sitting in stage 1, the default expectation is low. A big portion of that book is sitting in construction and real estate, as you will see on slide 21. And those have really suffered from the lack of FX liquidity in the market. And that's what mainly led to that restructure. So that's most of the book. So in summary, mostly in stage 1, and therefore default rate is expected to be low.
Thank you, Kola. Can I ask Olumide to take the question on asset growth in AUM, and what has happened with the transfer window? Thank you.
Thank you, Doc, and thank you, Ronald, for the question. In terms of churn, we've seen little churn as at yet. You may recall that the transfer window actually opened middle of November last year. So it's still very early days, and I think that for now we're still seeing a bit of lethargy in terms of movement, but we are we think that with more awareness, maybe customers will then effectively exercise their option to go to a service provider that will meet their expectations, and we continue to stay close to our own clients. In terms of asset growth, we're still expectant that we'll continue to grow our assets in the way we've done over the last couple of years. Thank you.
Thank you, Olumide. I will call on Wole Adeni, the Chief Executive of the bank, to handle the question pertaining to deposit growth, given the robust performance we had in 2020, whether we are able to still meet this market guidance.
Thank you, Ronak and Doc. I think our continued investment in digital channel will enable us to see the sustenance of this, and what we're doing with on all our channels, with both from the velocity perspective, from a scale perspective, and from even driving our risk asset growth. We believe that all this investment will definitely lead to the sustainability of the deposit growth that we've seen. You could see the growth in the Casa Ratio year on year, and we expect that performance in terms of deposit also will be sustained.
Yeah, fine. Thank you very much. Okay. Then on the last question had to do with trading income expectations. I would like to call on Eric Fajemisi, please. Do you want to quickly help us to handle that? But please bear in mind that we didn't give any guidance for that. Thank you.
Thank you, Doc. Thank you, Ronak. Ronak, as you may be aware, very much so, that trading opportunities are a function of the market volatilities that we may see in the year. And this also is a reflection of movements along the yield curve, which obviously responds to policy trust and initiatives. So I think the assignment for us will be to remain very vigilant and be in the game, and we will take advantage of every opportunity that comes our way in a reasonable manner. And it's something where we've done quite well in the past and will continue to do so. Thank you.
Thank you, Eric. Thank you, Ronak. I believe that answers your question.
Thanks. Just a very quick follow-up on the last question. Do we expect a trading loss to materialize given the sudden and significant reversal in yields we've seen in the last month or so?
We don't. The short answer is that we don't, and that's the short answer. We don't expect to make a loss. We've got a very active global market department trading on different instruments, both fixed income, FX, money markets, and the rest. So they will give it their best shot. Thank you.
Thank you.
Thank you, Ronak. If you wish to ask questions, could you please indicate by raising your hands? Okay, the next question is from Toyosi Oni. Toyosi, please go ahead and unmute your mic. Hi, Toyosi. Toyosi, can you please unmute your mic? Thank you.
Hi, can you hear me now?
Yes, better. Thank you.
All right. Thank you very much, Team Stanbic, for taking out the time to speak to us today. I just had a quick question, and that's on your gross loan outlook. So you're targeting 20 to 25%, and that is a bit robust given the operating environment we're in right now. So I just wanted to ask what sectors in particular will be driving that level of loan growth. Thank you.
Thank you, Toyosi. I will call on Wole to help us to quickly address that.
So we continue to focus on the resilient sectors, and we'll look at three key sectors that, that our customers are performing well, and they have the outlook of those sectors are very, very competitive and compelling. And based on that, we use those key sectors as the basis for our risk appetite target. So while we're seeing, even despite the fact that the first quarter, the last quarter performance of the GDP has shown us the area that are resilient as well. So we used all those as a basis for determining those key sectors that we'll focus on. So it's around those key sectors that will basically drive the risk appetite and the growth we see in our loan book.
Thank you. Thank you, TLC. Adewale Okunriboye, you have the floor. Kindly unmute your mic and go ahead with your question.
Okay, good afternoon. Thank you for the presentation as well as your results. I just want, first question is your payout looks very strong. I mean, I'm not complaining about it, but I just wanted to get a sense as to what's driving that, what's driving the confidence with that. Is it something that I think is sustainable going forward? I mean, not that we're complaining as shareholders. I think just to get a sense as to what your thoughts around what is driving the payout, both the stock dividend as well as the cash payout. Secondly, I'm looking at your guidance and I'm seeing for cost of risk, so your 1.6 for 2020 was informing the pickup over 2021, or is it just a conservative estimate you're providing there? Thirdly, your Casa, what are you saying that is making you think it's going to come down? I suspect probably will be interest rates, but what was driving your guidance that it's going to come down over 2021? Lastly, your name guidance is still pretty much unchanged, and I see there's an asterisk there. Maybe you might have answered this earlier, but in view of what's happening, interest rates going up and all over the place, why are you still leaving it unchanged? That'll be all from me.
Yes, thank you very much, Wale. I'll just take the questions the way in the reverse order. Look, when you're talking about the name and what we are guiding towards the name, we are being conscious of the movement in interest rates, and to the extent that we are conscious of that, we've looked at all the variables. Don't forget that even though interest rates could be going up, interest rates applicable to deposits will also go up. Customers are already asking for higher interest rates. So we are bearing all those things in mind. And we've deliberately put asterisks there is to show you the definition. The definition we are using for our name is the Basel III, regulatory whatever definition, right? Which is very important. And the idea for us is to make sure that we can compare, it's good to compare Apple, with Apple. For net interest margin, we have net interest income as a percentage of total assets, excluding derivative assets. It's total assets. So if you have a balance sheet of, let's say, 2.3 or a balance sheet of 3 point something trillion, and you exclude your derivatives, if your derivatives are 200 billion, so you are looking at a base of 2.8 trillion. That's what we do. So that's the definition. Then when we come to Casa Ratio, we are also being we are being very frank. It's not that we are being conservative, we are being very realistic. We try as much as possible to be candid, and we are candid upfront. And you see that when you go back to this slide 40, look at the market guidance that we've given. If you check all the parameters, 1, 2, 3, 4, 5, 6, 7, 8, 9. Out of 9 parameters, we met almost all of them, apart from return on equity that came down slightly because of the fact that we grew our capital. So when we say that our Casa Ratio we are guiding towards, let's say, 75%, is because we are conscious of the fact that our growth, the growth we are looking at, we may have to look at that growth
by actually paying more for deposits. And so we are bearing that in mind. So that's the second one. Then you are talking about, the dividend payout. I mean, I thought as an investor, you will be glad, you will be happy, right? One of the things we've committed to is a dividend payout ratio minimum of 30%. So any day, anytime, our dividend payout ratio of 30%, we will keep to that. But do we see, what will happen in terms of, okay, this year, what will pay out? We can't give that, and it's not part of the guidance. But the important thing is that we need to bear in mind, just the same way we've given our customers, we've given our staff members, a lot of what you can call support and palliatives and all those things arising from COVID-19. We believe that in being fair to all stakeholders, we should also give shareholders. These are shareholders who have stayed with us through the thick and thin. So we've performed very well. We give them dividend. We've performed very well. We give them bonus. So I believe you should be happy. But are we committing to repeating the same thing? It's not part of the guidance. What we are committed to is a dividend payout ratio of 30%. And I think we've been able to deal. Then you are talking about credit loss ratio of I mean, to the extent that we recorded 1.6, we are still keeping it at -3. These are the things we are meant to work with, right? We are guiding towards keeping it below 3%. 3% for us is a no-go. We will stay below it. That's why we put it there. Is equal to or -3%, right? And when you look at what is still happening, don't forget the economy is still very fragile, and it's good to bear that in mind. So this is 2021. Even though Nigeria is technically out of recession, the economy is still very fragile. Inflation rate is still heading upwards. Food inflation is already above 20%. Core inflation is already above 12.5%. Unemployment is still rising. We need to bear that in mind. FX illiquidity is still a challenge. When you look at that, then the heightened insecurity issues. So we are bearing all those things in mind because it will have knock-on effects on our customers. So when we grow our loan portfolio, it's not impossible that some of those guys will come back and say, hey, guys, I need help. So we are being very realistic. We are being very candid. It's not that we are being very conservative. Thank you.
Okay, I think just try to create impression. So yeah, I wasn't complaining about your dividend. I think it's a very good policy. I think it's, said congratulate you on that. Just a follow-up question. What size of your balance sheet, your net long dollar position, and what's your view on the naira over 2021?
Thank you very much. Kunle, do you want to take those two questions?
Thank you, Doc, and thank you, Adewale. We're long $12.5 as of December, at $12.6 million. On the FX, I think on the FX, the outlook is that the illiquidity is in the market. There are pent-up demands. We've seen oil prices increasing because of the vaccine program, but we've also seen that the oil prices has also started coming back. Production is a bit weak, so the outlook is very conservative. We believe that Central Bank will do all the things that they have been doing to protect the currency. So outlook is very conservative. Thank you.
So you're not giving a number?
I mean,
sorry, I don't have the number.
Wale, look, the important thing is that, look, even if you ask those who are really in charge, they can't give you a number, to be quite frank. I mean, what we do internally is to work with different scenarios, but to be so certain as to the number, then we won't be bankers. We'll be doing another thing and be making so much money if we can get the number right.
Okay, thank you. That'll be all.
All right, thank you, Adewale. Next question is from Timothy Wambu. Timothy, please unmute your mic and go ahead with your question, please.
Hello, good afternoon, gentlemen. Just a couple of questions from me. Thank you for the presentation. The first one is on the loan growth pickup that we saw in Q4. So when I look at, loans had only grown by 5% in the first 9 months of 2020, rather in the first 9 months of 2020, about 5%, and then you saw strong pickup at year end to grow by about 17%. So I want to get your view on this. Is it to do with you trying to comply with the cash reserve ratio requirement, or could this have been due to the release of some of that money? Just want to understand what's triggered that strong performance. And still on that conversation, give us your views on your compliance with the cash reserve ratio requirement going into 2021, where do you stand currently? Second question is on the digitization slide. I just wanted to, it seems a bit odd that ATM volumes are higher than your USSD, mobile banking, etc. I would imagine that ATMs are more expensive to run and even just to set up. Yeah, what's the goal around that? Is there a plan to move more towards your, I would say, mobile as opposed to hard, as opposed to physical infrastructure? And still on that same conversation, on the USSD conversation, what sort of impact do you see, given that it appears the banks are going to have to shoulder the cost or pass it on to the end consumer? And then just lastly, on your restructured loans, I can see that the real estate portfolio is the bulk of it. This is the COVID-19 affected loans. Help me understand what's going on there in that segment. I know you had mentioned FX liquidity as a reason, but here it's given as a COVID-19 related impact. So I just want to get a sense of what exactly is going on in that segment. Is it under a lot of stress because of the current pandemic? What's the outlook? Thank you.
Yes, thank you very much, team. Thank you for your 4 questions. They are more than 4, because even though you are saying 4, every question had a subset. So what I will do is to deal, the first one that you are talking about in terms of loan growth, and in terms of Q4, what happened, why. You remember that at the beginning of this presentation, you remember that technically Nigeria came out of recession in Q4. Technically, because Q4, we saw the GDP growth rate for Q4 coming in at 0.11%. We are fortunate because we are a member of Stanbic IBTC. So we've got our own research department. We've got, our own, purchasing managers index. It's a forerunner, right, of GDP performance. So we knew that things have started to pick up in Q4. Because of that, instead of just waiting for the official release, we continue to engage. Don't forget that we mentioned the fact that we were engaging our customers robustly. Q2, Q3, we were engaging them, and we are showing them the figures that things have started to pick up. So it was time to go, and we moved. So it has nothing to do with whether something was released or not released. Even the conversion of cash reserve, to special treasury bills took place maybe the last week of December, something close like that. So, but this is based on the performance of the economy that we saw, checking exactly the statistics and being very proactive. So we engage our customers, and they also saw it, and they were convinced, and they were willing and ready to start doing what they are meant to do, what they know how to do best. So that is number one. Related to that is the LDR, loan to deposit ratio. We've always complied. Go and check our statistics on a month-on-month basis, on a quarterly basis. When we release our results on a quarterly basis, we've always been above 65%. One of the things we've mentioned on the call, in the past, when this whole index was promulgated, was that we will not sacrifice loan quality, for the sake of compliance. Because we can quantify, if we don't comply, we can quantify what CBN will do. CBN will debit you for X percentage of the amount that you are meant to have booked. That one they will return with time when you grow your balance sheet. But we cannot go and book a bad loan just for the sake of compliance. But the important thing for us is that we've always complied. And even the outlook going forward, we will comply. We have no reason not to comply. because we've got the customers and we are working very closely with them. So that is that. Now I will ask Remy Oswagu, who oversees our PBB business, to take the question on digitization. Then Kola Lawal will take the question on restructured loans. Remy, you have the floor.
Thank you very much, Doc, and thank you very much as well, Timothy, for your question. You're right. We will continue to make sure that in terms of serving our clients, we provide them the most convenient means. And so, yes, making sure that we get those clients on our mobile app and other channels that is provides convenience for them continues to be a focus area for us. With respect to the question you asked on USSD, that issue is still evolving. We do have our internal response to that in readiness, assuming we face a push comes to shove situation. However, it is still a very much evolving situation, and we're well positioned to make sure that we deal it accordingly. Thank you. Hola.
Yeah, thanks, Timothy. Your question on the real estate portion of this restructured loan. Yeah, so two things. Yeah, it was indeed FX liquidity, as you know, the stress that we've been facing on that leg. So most of the assets were sitting with Naira, but unable to just find the FX liquidity in time enough. The other issue specifically relating to COVID-19 was just lower footfall on the in the malls and in the assets, and we therefore took a prudent view that there will be stresses to their cash flows over the coming months, and therefore assisted with extensions there. The outlook for that sector remains at best muted, given the continuing stress in the macroeconomy. But the 4 or 5 assets that we've got have got very strong sponsors that have continued to support even through stressed scenarios or situations, and we expect that to remain. But the outlook for that sector is muted. Thanks.
Right. Thank you, gentlemen. Thanks.
The next question is from Ronak Gadia. Ronak, please unmute your mic and ask your question. Thank you.
Thank you, Idris. Just a couple of follow-up questions. Could you give us some guidance on your tax rate going into next year? The second question is on your OPEX. Your cost base has been relatively flat the last 2 or 3 years. Could you give us some guidance on what kind of growth rate we should expect on that, especially given the investments the bank has to make on the digitization side? And the final question is on your balance sheet. So, undoubtedly, management have done a very good job of growing the Casa deposits over the last few years, but it doesn't seem like the bank has benefited from that, because a lot of those deposits are sitting free of charge as CRR at the CBN. So, despite the increase in Casa deposits, the bank has had to look for other sources of funding, interbank borrowings, long-term borrowings to fund its other assets. So, is this a trend that you think will continue, i.e. most of your deposits will just go to the CBN and you'll have to continue borrowing within the interbank market from standard bank affiliates, etc.?
Yes, Rona, thank you very much. What I will do is that I will take the balance sheet and I will get Kunle, our CFO, to answer the questions on tax rate and OPEX. On the balance sheet and your specific question had to do with, okay, fine, even though we've grown Casa, but we are still, taking, some kind of interbank, some kind of, borrowings and all those things. We've seen a trend, and the trend is that it can only improve. Right. We are coming from a very, what you can call difficult space in terms of, liquidity management, from the regulators, where we've had, massive, cash reserving, policy. But those things are steadily easing off now. And we believe that it can only improve. Right. So if it improves, we will enjoy the benefit. If not, we are ready, and that's the important thing. We are just being we are being proactive, and we are ready, right? But we've seen signs, we've seen green shoots. What do we mean by green shoots? Towards the end of last year, some of the cash, reserves that we got were converted to special treasury bills, even to a 0.5%, per annum yield. That is better than just raw cash sitting in CBN. And we've also seen examples, later in the course of the year, where we've got one or two, refunds. So we are seeing improvement. However, we are ready if, the situation fails to improve. Kunle, please, do you want to handle the other two questions?
Thanks, Demola, and thanks, Ronak. So the effective tax rate reduced for the banking subsidiary due to change in basis for tax provision from SX dividend tax to minimum tax. So the same basis will be applied in we would likely apply to in 2021. So for the group, effective tax rate was 12.1. So in terms of guidance, I would say broadly between 10 to 15%. On costs, yeah, you are right. We've been focusing on costs, but I would say apart from the benefit from the new ways of working, where we've seen a decline in travels, entertainment, we've actually put in a number of energy efficiency initiatives. We're installing renewable energy system in our branches, and some of our branches are currently running on solar. We're also in discussion to power our two largest campuses on natural gas power energy. So that we continue to focus on that area so that we can effectively have a better return as the economy grows, and we also get income from new loans. Thank you.
Thanks, Kunle. Just on the tax rate, if you could give guidance for next year, because I understand that's when the big change comes, because the interest from government securities is no longer tax-free.
Are you talking of 2022, Ronak?
2022, yes.
I think we have to wait a bit, because we don't really know what the government will do, so we have to wait a bit and see the direction. But I suspect that government will continue to find ways to encourage investment in government securities, given that they also have deficit and they've been borrowing. They could extend the 10-year the policy after the 10-year expiration, but we don't know for sure. Thank you.
Okay, thank you.
Thank you, Ronak. Adewale Okuruboye, I believe you have a follow-up question. Please go ahead.
Yes, just one question. So I'm going to ask, how are you classifying your CBN bills on your books? Why I'm asking is because I know they were issued at, I think, 0.5, and I suspect there is subsequently rolled over at 0.5 as well. However, I think they are trading much higher in the secondary market. Yeah, I think they're trading much higher in the secondary market. So how are you classifying these on your books? Are you classifying as held to maturity or as fair value?
Yes, our CFO. Yes, Wale, our CFO, will answer the question. Kunle.
Thanks, Wale. It's part of our financial investments on the balance sheet. Thank you.
Okay, so because I can see on your balance sheet is, well, I think I just look at, I think it's about 600 billion or so. What's the number for you?
Yeah, so you have about 507 as part of that financial investment. Thank you.
Okay. So did you dispose of it during the period, or you still held it as? Okay, I guess that's
the total amount that was given, and as noted by Demola, we actually got the piece towards the end of the year. So the total amount is still part of that financial investment line. Thank you.
Okay, so are you on the financial investment? Is it being classified as fair value or health? Or, sorry, I'm just trying to.
We have our business model. We have our business model, and we classify appropriately.
Okay, why I'm asking is just because I'm just trying to get a sense that if interest rates have risen, what's likely going to be the impact on that? If it's positive or negative.
Yeah, what I'm saying is that we have our business model, we have our policies, and we always continue to apply it, depending on what bucket is classified.
Okay. All right, that will help.
Thank you.
So we have a question in the chat room and from Sanelda, and the question reads: according to the presentation, the loan restructure due to COVID is 50.97 billion naira. However, in the audited financial statement, the renegotiated loans total 11.7 billion. Why this difference?
Kunle, do you want to take that, or?
I think I have to take in this and probably get your contract.
Thank you, Sanelda. We'll get back on you. We'll get back to you on this. If you wish to ask any question, please signify by show of hands. Thank you. Okay. In the absence of no further question, I will now hand over to Dr. Demola Sogunle to give the closing remark. Doctor.
Yes, thank you very much, Idris. Distinguished ladies and gentlemen, we thank you so much for your support over the year. We thank you, for all the questions, that you've asked. And please, if you still have more questions, please, you can get across to Idris. We will look back, we circle back to you very quickly. Thank you very much. Please keep well, stay safe, get your own vaccination, and have a pleasant weekend. Thank you very much.
Thank you very much. And this concludes the session. You may all disconnect now. Thank you.